The US stock market should have already collapsed. Every major indicator that historically signals disaster is already blinking bright red. Consumer debt is at suffocating levels, corporate earnings are stretched thin, and underlying economic fractures are widening faster than the average American realizes. Yet the market, against all logic, against every historical trend, keeps pushing higher, and it leaves millions of Americans asking the same question. Why hasn't the stock market crashed yet? This is Oblivion, and I've spent years studying the financial system not just as a set of numbers, but as a repeating pattern of human behavior. Markets don't move based on math alone. Markets move because psychology, power, and policy intersect behind closed doors. When you look at the market like a historian instead of a speculator, you see the same rhythm repeating across centuries. Optimism, denial, leverage, euphoria, delay, and then collapse. The instruments change, the technology changes, but the script stays the same. Today, we're living through one of the most surreal moments in market history. The stock market is floating at valuation levels that make the dot-com bubble look conservative. The numbers aren't just high, they're historically impossible without manipulation or artificially engineered support systems. And yet, the crash everyone expects simply hasn't happened. But before I break down the hidden forces keeping this inflated system alive, let me know in the comments where you're watching from. I always like seeing how far these conversations reach. The truth is that the institutions on Wall Street and policymakers in Washington do not want the average American to understand why the market hasn't fallen. Because once you see the mechanics behind this bizarre delay, you also understand why the eventual correction will be far more devastating than anyone wants to admit. The paradox starts with valuations, numbers so extreme they barely make sense even for those who work inside the system. One of the cleanest ways to judge whether the stock market is overextended is the same method Warren Buffett uses, comparing the total market cap of all US equities to the United States GDP. Historically, anything above 100% means the market is fundamentally overpriced. Before the dot-com crash, this ratio hit 150% and the market collapsed 60%. Today, this ratio is not 115%, it's not 150%, it's not even 180%. It's 220% with the US stock market valued at roughly $66 trillion, while the entire US economy produces around $30 trillion. You don't need a PhD in finance to understand how insane that is. It's a level of detachment that suggests the financial system has become completely unmoored from the real economy, the jobs, businesses, and working Americans that are supposed to justify these valuations. People think the market is soaring because everything is fine. But the real reason is more dangerous. A handful of companies are propping up the entire structure. This is where the market's fragility gets frightening. Historically, the S&P 500 traded at price-to-earnings ratios around 15 or 16, normal, sustainable, grounded in actual profits. Today, it's pushing 25 to almost 30. But averages hide the truth. The real distortion comes from the fact that nearly all of the growth is concentrated in a tiny handful of companies. Nvidia trades at a P/E ratio over 50. Tesla's is in the triple digits. Investors aren't buying companies, they're buying dreams. They're buying future earnings that may never actually materialize. In every historic bubble, from the South Sea bubble in the 1700s to the dot-com mania in 1999 to the housing bubble in 2008, the same pattern emerges. The belief that this time is different, that the future justifies abandoning rational pricing. But the truth is that nothing is different. The psychology is the same, the overconfidence is the same, the concentration of risk is the same. And yet, despite all of this, the US stock market continues to rise. Why? Because three hidden forces are holding everything together. Forces so powerful and so artificially engineered that the market is no longer a reflection of economic reality, but a reflection of policy decisions and financial engineering. The first force keeping this overinflated market alive is relentless government spending combined with Federal Reserve monetary expansion. Over the last decade, Washington has spent money at a scale unprecedented in American history. The government issues debt, and the Federal Reserve absorbs the shock through liquidity expansion. Whether it's called quantitative easing, emergency lending, or balance sheet support, the mechanism is the same. Create artificial money and inject it into the financial system. But here's the part they never explain to the public. That money doesn't flow equally to everyone. It doesn't go to school teachers or construction workers or small business owners. It goes to the financial sector first. The banks, the asset managers, the institutional investors. This is called the Cantillon effect, a 300-year-old economic principle that determines who benefits from monetary expansion and who loses. The beneficiaries are always the same, those closest to the source of new money. That's why the top 10% of American households own nearly 90% of the entire stock market. It's not because they're smarter, it's because the system is designed to elevate asset owners above everyone else. When dollars are debased, assets rise, not because their true value increases, but because the measurement tool, the dollar, keeps losing value. The second hidden force is the mechanical structure of modern investing. Passive index funds, things like Vanguard and BlackRock ETFs, now control more than half of the ownership in the S&P 500. This means money is no longer flowing into companies because investors believe in them. Money flows automatically into companies because they exist within the index. It's a mindless, mechanical upward pressure that funnels billions into the same few companies day after day. This creates a feedback loop. The biggest companies get bigger because they're big. The more inflated they get, the more the index requires investors to buy them. This is not investing. This is autopilot momentum, and it creates artificially stable markets that appear resilient until they suddenly aren't. Because when the selling finally starts, passive funds are forced to sell proportionally. And the largest stocks take the biggest hits. The structure that pushed the market up becomes the same structure that accelerates it downward. The third and most dangerous force is what I call regulatory illusion. After the 2008 financial crisis, the U.S. government passed laws like the Dodd-Frank Act intended to stabilize the banking system. And on paper, the major American banks look healthier than they've ever been. They appear well-capitalized, low-risk, and heavily regulated. But that stability is an illusion. The reason banks look safe is not because they eliminated risky behavior. It's because they moved it somewhere else. This somewhere else is the non-bank financial sector, also known as the shadow banking system. This system, worth more than $4 trillion, is not regulated like traditional banks. It holds high-risk loans, leveraged debt, distressed credit, and all the things that would make major banks look unstable if they kept them on their balance sheets. By shifting the most dangerous financial products into the shadows, banks appear safer than they actually are. But the risk still exists. It's just hidden from the public. Think of it like sweeping explosives under the floorboards. Just because you can't see them doesn't mean they won't eventually detonate. This strategic relocation of risk is the real reason the stock market hasn't crashed. The danger has not been removed, only disguised. But here's the part that most people misunderstand. Delay does not equal safety. Every major financial crisis in history, from the 1929 crash to the dot-com burst to the housing collapse, followed the same psychological pattern. First comes irrational resilience, when the market stays high longer than anyone thinks possible. Then comes crash fatigue, when investors become numb to bad news. They hear about inflation, layoffs, recession signals, but they stop reacting. And then finally, one day, confidence breaks. Not slowly, not gently. One moment everything is fine, and the next moment, panic grips the system. A bankruptcy, a credit event, a major company missing earnings. Something sparks the shift. And because the market is so concentrated, so leveraged, and so artificially inflated, the fall becomes violent. We are living in the delay phase right now, the most dangerous phase. Because the longer this inflated structure is held together by artificial forces, the more catastrophic the collapse will be when the support mechanisms fail. And that collapse is not canceled, only postponed.